course, there's property overhang. Next slide. If we move on, then we still think there will be a rate cut. The market is pricing in 3 rate cuts in 2024. For us, we think there'll be 1 rate cut, because what we do see is that although the bonds continue to rally, bond yields continue to rise, we do see that the most important is that core inflation is coming down. You can see the red line is trending down quite sharply. The latest reading is 3.9. The trend line is to hit the 2% or the Fed's target by middle of 2024. Most important is the housing inflation has started to turn around, which is a very long. You can see, housing inflation takes long time to turn around, because most of the tenancy, rental tenancy are locked up for almost a year or so. But it's starting to turn around, and this will be the one that can help push down core inflation. Next slide. Okay, I will go through the usual sector trends. I'll start off with Glenn for banking sector.
Excuse me, sorry. Thanks, Paul. Yep, so for the banks, we'll start off with the usual, the interest rates. So you can see the dark blue and the light blue lines. That is the Fed fund rates as well as the Singapore interest rates, the SORA, respectively. So you can see that they have been actually keeping up. Even the SORA has been, although it has not increased as much as it was in the last year or the last 2 years, it has increased. It has continued to increase, and it hasn't actually dipped. So you can see that the last quarter, the banks have reported quite healthy net interest margins, and this is very dependent on the interest rates. So we do expect this to sort of continue going into the last 2 quarters of this year, and that's why we have a plus 32 basis points forecast for 2023. You can see, so if you look at the red line here, it extends past the two other lines, because that is the forecast for 2023 and 2024. However, we do expect that it will dip in 2024. This is mainly due to the dip in the interest rates. But we feel that the funding costs have been stabilized, and that's the reason why the dip is not as large as it should be. So now moving on to the next slide. Yeah, this is just a brief recap of what happened in the second quarter, and the main highlight being that the dividends have actually jumped 39% overall. And this is mainly from their NIM improvement, net interest margin, as well as the net interest income improvement. So look at the top red box there, you can see that the NIMs have continued to surge, and it was across the board is around 45 to 58 basis points increase for all 3 banks. And this has resulted in the net interest income increasing by 31 to 41% for the banks. And resultantly, this resulted in their PATMI also improving greatly. It's the third last row there, from 27 to 45%. But I think more importantly, would be that the dividends have also increased, and this is to reflect the increase in their earnings. So the dividends have risen by 33 to around 43%. And we do feel that there's still room to grow, as the net interest margins will continue to remain high, at least for the next few quarters. Now moving on to the next slide. Yeah, so the next slide, it just shows the CASA, or this stands for current account savings accounts ratio, as well as the total CASA. So what is CASA? CASA is the banks, they hold this very low interest, they have to pay these very low interest assets. So this would come in the form of the money that you put into your current account. So for all 3 banks, it will be DBS will be the multiplier account, OCBC will be the 365, and then UOB is the one account. So the money that you put in there, so while it might seem like they give very high interest rates, but that is if you meet all the targets. The base interest that they give out is only, I think, half a percentage point of interest. So this is very low interest sort of they need to give out. So this is their best sort of funding cost that they have, the lowest funding cost. And with a higher CASA proportion, as well as higher CASA, it means that their funding costs are much lower. So for the last year, so around 2020, the end of 2021 to mid-2022, the CASA as well as the CASA proportion of deposits have been dropping over time. And this is mainly due to the higher interest rates, and the customers have moved their CASA to other sort of deposits, such as fixed deposits, which earns them higher interest. So it has been slowly declining for a year, as you can see from the red line there. But recently, in the last 6 months, it has actually stabilized at around 18.8 to 18.9%. So this sort of reflects what the banks have been saying, that their funding costs have sort of stabilized. So we can see it reflected in this CASA proportion as well, where we feel that moving forward, the CASA should maintain at this level, and their funding costs have sort of stabilized, so they have more to earn from the rising interest rates. So that's all I have for the banks. I'll now hand it over to Darren for the REITs. Thanks.
Yeah, thanks, Glenn. Yeah, so for the REITs, this is just the performance of the third quarter. So the orange line is the year-to-date performance, while the blue color is the performance at the third quarter. Yeah, so just one thing to note is that the performance in the third quarter was dragged by the last 2 to 3 weeks, because after the Fed meeting, where the stance was higher for longer, yeah, a lot of the REITs, the share price really corrected quite a bit. So it was down about 6% within the last 2-3 weeks after the Fed meeting. Yeah, so which is why the performance in the third quarter was all dragged down by that. And from that, we also see that the industrial subsector is the outperformer. Year to date is up 5.2%. Yeah, we think this is because of the double-digit rental reversions that a lot of the industrial REITs they announced the double-digit reversions. Yeah, so next slide, please. Yeah, so this slide is the Singapore dividend S-REIT dividend yield spread over the 10-year Singapore government bond. So it's basically the dividend yield of the REIT index minus the 10-year bond yield. So how we see this chart is that the 10-year bond is a yield proxy, or rather a risk-free rate proxy, where how much above the dividend yield is this risk-free rate of the 10-year yield is basically how much are being compensated for if you invest in REITs over the kind of the risk-free rates. So as you can see here right now, the yield spread has fallen really to about minus 1 times standard deviation to the mean of about 3. So this means you are not being compensated as much as before when you invest in REITs. But the thing is, because of the sharp share price correction, we think that some of the negatives, like the higher for longer stance, has already been priced in, as you can see in the next chart. Yeah, so this is the price to NAV. You see that the share price of the REITs has already fallen to 0.86 times price to NAV. So that is about -2 times standard deviation and is below pre-COVID lows already. Yeah, so because of that, we think that some of the negatives, or rather a lot of it, has been priced in already, and we can start to reposition into REITs for that eventual rate pause or rate decline. Yeah, next slide, please. Yeah, so of all the REITs, we still like the hospitality subsector because we think this is a subsector that really can generate the DPU growth. Right now it's RevPAR, which is the revenue times occupant. RevPAR, which means average daily room rate times the occupancy. So it's at all-time highs. Month on month it declined because of seasonality, but year on year is still up and is at all-time highs. And the visitor arrivals is still not back to pre-COVID levels right now. China accounts for about 55%, and we think 55% of pre-COVID Chinese travelers. So we think this return in Chinese travelers in the upcoming few months will really help to boost up this visitor arrivals back to the pre-COVID levels. And as a result, the RevPAR will likely continue to increase. Yeah, and we also think hospitality is probably the only subsector that can generate DPU returns, DPU growth, because of the increase in RevPAR will directly translate into top line growth, and they can more than offset the increase in interest rates going forward. Yeah, next slide, please. Yeah, so on property, this chart is basically the take-up rates for the first week, or rather the launch weekend take-up rates for this year. As you can see, is not 100%, because most of the take-up are 20%, 30%. Yeah, gone are the days like last year, a lot of the launches were straight away taken out over the launch weekend. As you can see that because of that, there's more supply, so the demand actually tapered off. And there's a chart at the bottom, which is the launch pipeline. It was 4,500 last year. This year is about 11,000. So it's a 155% jump. So because of the new supply, we think that the demand will be more muted as a lot of the consumers, like first-time buyers, they have more options, and there's absence of foreign buyers because of the higher EUSD that they announced in April this year. Yeah, so we are neutral on property. Yeah, so that's all for me. I'll hand over the time now to Peggy. Thanks.
Thank you, Darren. Okay, I'll talk about conglomerates today. The conglomerates comprises mainly Keppel and Sembawang, and both of them derive their earnings mainly 70 to 80% from energy sales in Singapore. This chart shows the industry-wide capacity. The blue, please look at the blue shaded area. That is actually over the years, our energy capacity in Singapore has been on a decline as we have retirement of the coal-fired plants over the years. On the other hand, demand has been rising. The red line shows the reserve margin. Reserve margin is calculated by using the peak demand at any point in time of the month over the capacity at that point in time. So reserve margin, the lower it is, the more dangerous, because it means that our capacity is almost fully utilized. So the line here shows at some point our reserve margins was as low as 20%, which is not healthy. The rule of thumb is to have a reserve margin of 35%, and the EMA, Energy Market Authority, has always strived to meet a 45% reserve margin. So there are more power plants coming up that will run on the newer the cleaner fuels like hydrogen, and of which Sembawang and Keppel Corp are the major player in this area too. So we therefore think that the conglomerate sector will continue to ride on the higher domestic consumption demand for power. Move on to the next, please. Okay, this is building materials and construction sector. We have an overweight on building materials. If you look at the chart here, it shows the contract awards on the blue line. That has been rising since the dip in 2022. And contract awards typically translate into progress payments 12 to 18 months down the road. So the line, despite the decline in contract award last year, progress payment has been holding up quite steadily, as the projects are being speed up to meet especially on the residential side for the public housing. So going forward with the record government land sales program and the HDB's promise to continue to build 20 to 23,000 homes every year, we think the progress payment, the red line, will continue to rise up, move upwards, which will benefit the building material suppliers like Pan United. But we have reservation for the construction sector, as the number of workers that they can bring in, and the levy will go up quite significantly from January next year. And there's a push towards the use of PPVC, which is a prefab module, that also will raise costs for not just on the materials itself, also the need to hire cranes and to have 50% of this PPVC requirement coming from the Singapore market, which is 20% higher price than those sourced from Johor. So we have an overweight on the building material sector. Okay, for the next slide, please. For air transport, as the title says, we think the recovery is almost done here. This recovery here refers to the overall total market recovery worldwide. I pulled this data from IATA. According to IATA, the July passenger volume is up 26.2% for the entire market. But this is 4.4% below the pre-COVID level compared to July 2019. But we think the most of this improvement in travel comes mainly from leisure demand, whereas corporate demand still have not picked up. Remains very weak as we adopt the more Zoom meetings, hybrid way of working. So that has helped the budget carriers, but the main carriers are not getting the passenger. So budget carriers, that typically means that the overall yield from the whole sector is lower. The other thing is that if you look at the right column for North America, which is US, it's actually exceeded the COVID level, and we are concerned that if there's a slowdown in the US, that could be the first market to see a decline. So therefore, we think that the air transport sector could have come to its peak demand cycle, and the higher jet fuel prices, which has almost recovered to pre-COVID, to the same level last year, is also weighing on the cost structure, and the recent issues with engine flaws in engine for Pratt & Whitney and CFM. It also means that airline might have to spend more time for MRO work, therefore less flight hours for them. Not helping, of course, is the broke out of the conflict at Israel, and which means that there could be diversion of flights, could be cancellations and higher costs for diversion to avoid the war zone, and the jet fuel prices look therefore look unlikely to be easing in the near term. That's our view for air transport, which is underweight. I'll move on to the next one. Next slide, please. Thanks. Okay, shipyard. Okay, the shipyards, we plotted the chart for the contracts, which have recovered this year, last year and this year. This recovery is driven by the IMO regulations that's moving the carbon emission targets to an earlier timeline. Now, about 40% of the order book here are vessels running on green fuel, such as methanol or dual fuel, or upgrades to like installation of scrubbers to meet the more stringent IMO requirements. There's also a demand for offshore wind farm installation work, but there are no capacity expansion. One reason we can think of is that these new vessels are of higher value, and so the volume, the number of vessels, and even though the order book in value is high, the number of vessels, the capacity the added is not as what you see in 2013 and 2014. And only those owners with deep pockets, i.e. the 5 key shipping lines, can afford and willing to embark on these new vessels, because the returns might not be able to justify, and the technology and regulations are constantly evolving. So not many yachts have to know how to do this kind of work as well. So Yang Zhejiang thinks they can improve their margins to above the current level with the new vessels, but there will be limited yacht capacity, and they are not expanding either. So, and these order books will be fulfilled, stretch out to 2026, and so going forward, we think the order intakes might slow for all shipyards, and the higher cost of capital, given the higher interest rates, could also deter investment decisions. Therefore, we have a neutral on the sector. Thank you. I'll pass back to.
Yeah, thanks, Peggy. So we move on to the electronic sector. As the title suggests, we are worried over the end consumption. So right now, speaking to some semiconductor equipment companies, the demand they do see now is AI, but the volumes for AI or artificial intelligence is quite low for GPUs. And also the other one is that China is of course hoarding a lot of equipment. So those are the only pockets of demand. What we worry about is end consumption. What we mean by that, if you look at this chart, so this is the US retail sales of electronics and appliances. It's just a proxy of the electronic demand, and you can see that after the spike in 2021, 2022, because of the pandemic, growth has slowed down, even below the so-called underlying US retail sales. So it's below trend and continues to be weak after the big surge in 2021, 2022. You might see some pickup in demand because of inventory replenishment, but we think overall we are still neutral. Any recovery is, I think, is only probably more meaningful be second half of 24. Now, next slide. In terms of healthcare, again, we're also neutral. One of the reasons that we do see margins under pressure. So this chart here is basically the number of admissions going into public hospitals and private hospitals. You do see a spike in 2021. So there were three waves that benefited the healthcare sector, namely the hospitals. I wouldn't say benefited, but at least the revenue picked up. Mainly the first wave is because of the pandemic, vaccinations, the pandemic testing. So there was huge high margin business. Then thereafter, when the pandemic was at its tail end, then you got the second wave, which is foreign patients coming back into Singapore. Then the third wave was because the public hospitals capacity was just overwhelmed. Then the authorities started to have these transitional care facilities. These are like temporary hospitals, could be 100 bedder, 200 bedder. This also supported the earnings. It was also for some of the COVID patients. But all this is starting to wane off, and we think this will start to, based on the recent bid won by Raffles Medical, they bidded and they renewed their Changi TCF or Transitional Care Facility, which is a temporary hospital of about 151,000. But if you compare to their competitors, they're all like bidding like 400,000, some even 1 million. So either the rest have got it very wrong, or maybe Raffles is underbid. And you can see the volumes are starting to turn down based on this chart. Next slide. We'll move on to our stock picks. Next slide. So in terms of this is our model portfolio, we took out SGX. Although the thesis went in line, so for SGX, the interest rates did rise, their interest income did surge, and the earnings still rose. But I think the market is not giving them any re-rating or not rewarding the share price until they see volumes picking up. So that's why we took it out. I mean, we still like it, but just that I think in the near term, even with high interest income, there's not much re-rating by the market. CDL is mainly one of the big drags to our model. It's because of the whole property sector, especially high-end property sector. Since the cooling measure, this stock has been just hit very hard. We added SC Engineering, which Peggy will elaborate, and then we added Singtel, which I will also discuss later. But the biggest drag has been all the property related. You can see Escort for this quarter, and also Propnex was one of the big drags. Best performer finally was maybe Comfort. Yeah. Next slide. This is just a historical illustration of performance. The blue line is the model portfolio. The red line is just the underlying index. The one on the right is just the monthly performance. So we're still under, I think our exposure to prime, maybe took a tactical bet, our exposure to property has really hit the portfolio hard, especially in March. That was the prime effect. Next slide. Okay, so we move on to the stocks that we like. So one of the stocks that we like is still Thai Bev. The share price has weakened quite recently to about 53 cents. I think we think the GDP numbers coming out of Thailand kind of disappointed the market. So and the market is a bit worried that any fiscal stimulus by the government is going to be delayed. We like it because of the low valuations. It's trading at mid-teens, around mid-teens, 13, 14, and this is even lower than pre-pandemic. And we think next year there's going to be some fiscal catalyst. So as we mentioned before, the Thai government is going to have a big 21 billion, almost 3% of GDP spend for the economy, the digital wallet, where they'll give each individual almost 400 Sing dollar to spend in 6 months. Secondly, there's also the farmers' debt moratorium that the government has authorized. So there's another fiscal boost. And the third one is they're also raising the minimum wage. So all this is going to help the general economy and help consumption, and should should trigger a stronger earnings recovery for ThaiBev 2024. Next slide. Move on to ComfortDelGro. I think this story nothing changed. The picture is just to show that there's still growth in the ride-hailing apps in terms of the number of rides. And on the bottom is the street hail. So what we do see is that the rebound will be from pricing. So the pricing will come from number one, the UK bus repricing. The pricing will come from the removal of taxi rebates in China, and the third round of pricing will come from the introduction of platform fees and higher commissions, and also removal of taxi rebates in Singapore. And for volume recovery, it's mainly the rail traffic. So the any increase in rail, which is growing about 20+%, will go to ComfortDelGro. Next slide. Final one for me is just Propnex. We still like it because the yield is almost around 7%, and it's bottoming. So the results in the first half was poor. You can see mainly because of the blue line, the volume of transactions totally dropped because of the cooling measures and also the lack of launches. But since then, we think that there will be a recovery coming back up, mainly because of the new launch from 4,000 to 11,000 this year. And we really see so far, at least July, August, reflection of third quarter, the volumes are up about 40% year on year. So I think we'll move on to the next one. Sorry, last one for me will be Singtel. So we added Singtel mainly. So this is a chart of all the regional associates, the mobile price. So this is the best way to get a recovery, because if prices rise, it will just go straight down to the bottom line. So India has done exceptionally well. And then we see Indonesia. We think the next one should be Thailand, which has come down, which is AIS, Advanced Info. So that has from 3 mobile operators in Thailand now has gone to 2. The reason there's a bit more hesitation to raise price because the economy has been weak. Like we highlighted before, prepaid in all these emerging countries are all almost like a discretionary spend because they only pay as they use. And if the economy is weak, inflation high, there'll be less spending. The other thing is divestment. So we also encourage that Singtel has this 6 billion divestment plan. They've already divested around 2 billion, which is the data center, a stake in their data center business, and also 1 billion when they sold off the loss-making Trustwave business. Next slide. Okay, I'll hand it over to Glenn.
Yeah, thanks, Paul. Yep, so for our bank pick and our stock pick will be the OCBC, and this is our preferred stock pick amongst the 3 local banks, and this is due to 3 main points. The first one being that they have the most attractive valuations, and of course OCBC is also the cheapest amongst the 3 local banks. And secondly, I think more importantly, is the title. As the title says, the dividend yield has reached a record high. So OCBC's dividend yield is hovering around 6.5% right now, and it's actually the highest amongst the 3 local banks. So they also have the highest CET1, which is around 15.5% to 16%. So so what does CET1 stand for? Just briefly, CET1 stands for Common Equity Tier 1, and that is, in very simple terms, that is their equity, and it's the highest quality equity. So they did mention that, all the banks have a sort of optimal operating CET1 range, and that's around 12.5% to 13.5%. So what they can do to spend this capital would be mainly 2 things. Firstly is acquisitions, which is what DBS and UOB has done. They have acquired Citibank assets. And the second option would be to raise their dividends. So DBS and UOB, actually all 3 banks have raised their dividends, and OCBC has also raised it. But we feel that there is further upside to their dividends moving forward, as OCBC has actually not acquired and made any acquisitions or large acquisitions in the last few years. So we looking at the red line here, we have forecasted that the dividends could increase even further and might even hit 7% in 2024. And the last point being why we choose OCBC would be that there is an upside, or there is a sort of a potential increase in their fee income and wealth management side. They have mentioned multiple times about this 3 billion incremental revenue, and it's mainly coming from China. So we feel that by they have publicly said it, and it should further improve their fee income as well as their wealth management arm. So that's so as such we maintain a buy on OCBC at a target price of $14.96. So that's all I have for the banks. I'll now hand it over to Darren for the REITs. Thanks.
Yeah, thanks, Glenn. Yeah, so for our picks, we have CapitaLand and Scott Trust. So this chart is basically the RevPAR growth. As you can see, the year-on-year is still growing, but of course of seasonality, which is why the first quarter is down. But year-on-year continue growing, and we believe the return in China travelers, like just I mentioned, currently is about 55% of pre-COVID. Yeah, this will really help to boost the portfolio RevPAR going forward. Yeah, and just so happen I see a question in the chat that says is hospitality REITs DPU directly correlated to RevPAR? Yeah, so basically the higher RevPAR will directly contribute to a higher revenue line, and as a result, there are a lot of different line items after that, interest expense and such. But a lot of these hospitality REITs, they managed to increase their RevPAR. Their RevPAR increased so much that their revenue increased way more than offset the increase in interest expense, which is why the bottom line DPU can grow. Yeah, and so for CapitaLand and Scott Trust, the reason why we believe their share price is low is recently is because after they did a recent rights issue and a private placement. So the rights issue was priced at $1.25, and the day before the ex rights date, the share price was trading actually even below the $1.25. So as a result, a lot of the take up rate was not very high. It was only about 36.6% taken up for the rights issue, but the joint book runners, they fully underwritten the shares. So they raised in total about 300 million from this rights issue and private placement. The rights issue specifically was about 100 million, and the daily average trading volume for Escort is only about 7 million. So let's say if all those who took up the rights, they might want to sell the shares, it will take a while, and which is why we also think that there is this near-term overhang for CapitaLand and Scott Trust. But in the long run, we believe that the RevPAR will continue to grow, and this will really help to benefit that top line, and they also have DPU growth potential, and the forward dividend yield as of right now is at 6.8% after the share price correction, and we think this is a really attractive play for now. Yep, next slide please. Yeah, so for Freda Centrepoint Trust, that's our next pick in the REIT sector. Yeah, so basically their resilience is underpinned by the focus on essential services. About 55% of their portfolio is in essential services, like F&B and food and beverages, and the services that are needed by everyone, like daily, like dental, all these. You can see the top 10 tenants also is NTUC FairPrice, Breadtalk Group, Dairy Farm, which is a 7-Eleven, Guardian, Cold Storage, and Hanpopoy, which is McDonald's, Kopitiam. Yeah, so all these are really resilient sectors and tenants that even if in a economic downturn or down cycle, people will still go and patronize these places like supermarkets and like McDonald's. Yeah, so this underpins FCT's resiliency. And also another point is that their occupancy cost, which is the rental that tenants pay over their tenant sales, right now is at 15%, around 15%. Historically, it's about 17-18%, and during COVID, it hit about 20% or even higher. Yeah, so because right now the occupancy cost is only at 15%, there is a lot of potential for FCT to raise the rents, and as a result, they can get more positive rental reversions going forward. Yeah, so right now FCT is also trading at a DPU yield, a forward yield of 5.7%, and we think this is attractive for now. Yep, next slide please. Yeah, so for CLI, we like them because of their recurring fee income model. So as you can see in this blue line, we project about a 10% compound annual growth rate in their FRB going forward, backed by their strong lodging management fees. And so as you can see in the orange chart is the real estate investment side. The REIB business is not doing too good because of the absence of divestments. Because of this high interest rate environment, there are not many divestments, and capital recycling efforts are quite challenging, as well as the weaker Chinese performance in the Chinese properties. But all this is strengthened by the lodging business where they own and operate some of the lodging assets under the Escort brand. Yeah, so that is still performing very well. And basically we like them because of their recurring fee income model, and when all these divestments and event-driven fees start to come back in, right? Especially right now that there's more certainty and clarity about where interest rates are heading. Like it's easier to plan to maybe take up loans and such. So because of that, we believe that the event-driven and divestments will start to pick up pace going forward in the next few quarters as well. So that will really have to benefit both the fee income business side as well as the portfolio gains and the divestment gains from the REIB side. Yeah, so that is why we like CLI and we have a buy call on them. Yeah, so that's all for me. I'll hand over time to Becky to talk about STE. Thanks.
Thank you, Darren. Okay, ST Engineering, we recently initiated coverage on the company. Okay, just a background. ST Engineering derives 47% of its earnings from defense and security business. And this business also gives the higher EBIT margin of 14% to the group. Okay, this chart shows their order book on the red line. The order book is now at a record 27.7 billion, and this rises in tandem with Singapore's defense and security budget. Although not all Singapore's securities and defense work goes to SC Engineering, I think I estimate they have about 10% share of the Singapore pie. But still, the lines are always move in tandem, and Singapore has stepped up the spending in this space by 12% in 2021 and 22, and then another 6% in 2023. This is probably driven by the heightened geopolitical tension and cybersecurity threats. The other key segment for SC Engineering is the earnings is derived from the aerospace MRO, which is growing on the back of airlines bringing back capacity to the system. The recent issues surrounding engine flaws at Pratt & Whitney and fake engine parts from CFM would also mean more work for the MRO service providers like themselves. And we think that the eruption of the Israeli conflict over the weekend could probably mean more higher emphasis on this defense sector, which ST Engineering is one of the few in listed on the SGX, which will benefit or which will at least have their earnings from this sector very much insulated. Thank you. That's all. That's why we had a target price of 450, which is derived from the discounted cash flow model. As ST Engineering traditionally has been generating very strong free cash flow from the system. Thanks. Move on to the next stock. Keppel Corp. Okay, we maintain our buy call on Keppel Corp. Target price of 770. The Keppel share price has recently reacted to the movements of the REITs that they held. They have stakes in 5 listed REITs in Singapore. So the sum of parts will therefore be affected when the share price of the REITs are lower. The core earnings for Keppel is still derived from energy sale, about 70% in first half 23. The catalyst to share price uplift and our target price is their focus on asset monetization. They have about 66 billion in assets held in their books and via joint ventures that could be divested into funds that are managed by them on their platforms. This will raise the share of recurring income from fund management, and they also continue to generate revenue from the management of the physical assets. The target is to reach 100 billion Sing dollar of fund under management by 2026. So we think there's room for them to grow their balance sheet, to grow their revenue through this transformation. Thank you. I'll pass on to the
Thank you, Peggy. So we initiated Suntec last month with a buy recommendation on target price of $1.47 Suntec REIT is a diversified commercial REIT with 67 of revenue contributed from Singapore, 20 from Australia, and 13 from UK. We like Suntec mainly because of its cheap valuation. As shown on the graph, Suntec is currently trading at record low of 0.54 times price to NAV. That is very much below the average S rate of 0.86 times price to NAV, and the forward dividend yield is 6%. There are some concerns over Suntec's high gearing of 42.6% and its low portion of the fixed rate debt, which was 58% versus the peers, 76% of capital rate and 78% of CICT. However, we believe Suntec is able to benefit the most from interest rate cut. And in first half 23, they have successfully divested 3 strata units in Suntec office, with price 20% above book value, and the management is also confident that they can bring the gearing down to 40%. Yeah, that's all for Suntec. I'll hand over back to Paul.
Yeah, thanks, Mel. So I'll move on to the other recent initiation that we did, which is Valuetronics. So it's an electronics company. So although we did mention that we're a bit more concerned and neutral on electronics, but we think there are multiple downsides for this stock. So Valuetronics suffered almost 5 years of revenue decline as customers shifted out from their only factory, which is in China. We think this has the tide has turned because they started to build a new factory in Vietnam. So in terms of the downside, we see firstly there's a share buyback of almost 60 million or 32 million worth of shares that they've been buying even at these levels. So that is the first one. The second is, of course, the dividend yield is about 5% right now. The third is that with the new plant in Vietnam, they also announced 4 new customers, and which we think can help turn around the revenue for Valuetronics. And the fourth is of course, 80% of their balance sheet is net cash, which is I think almost 180 million of net cash. So we have initiate with a buy. Next slide. In conclusion, I think that in the US economy especially has been sprouted up by fiscal deficits and credit card. So this makes us concerned of the quality of the growth and the ability to continue, especially in this era of politics of austerity. As we've seen, they're even willing to do some government shutdowns and try to address the rising debt by the US government. The second is, of course, as you enter 2024, from fourth quarter, we do see several reasons that economic growth will be dragged down from excess savings, cola drag, student repayments, and of course, higher interest rates and a slower China. We are cautious on Singapore equities in the near term because, but that's why our portfolio is anchored in dividend yield and non-cyclicals. Okay, I think we can move on to Q&A.
Thanks, Paul. I think I'll start on the Q&A first. I see one question here. I'll read out the question. When the Fed pauses, the NIM will stabilize. In general, will the DPS payout by the Singapore banks drop? If yes, which of the 3 banks will drop its DPS first, and by what percent? Okay, so yeah, you're right. When the Fed pauses and interest rates generally start to either stabilize or it starts to dip, the NIMs will stabilize. That's true. But then again, the main point here is that the NIMs will stabilize, it won't drop. So if the NIMs don't drop, I mean, the earnings will also be stabilized, and they can do other ways and such as lowering their funding costs, which is what they are doing currently to maintain the NIM growth. But it will be, of course, much lower than what we are seeing now, which is more like 50 basis points growth every quarter. So yeah, the NIMs will stabilize, but it will not dip as much. So this will remain at these elevated levels at least for the next few quarters, and we could see that their net interest income and earnings will continue to grow. And also importantly, you must sort of understand that the banks, they don't just depend on NIMs. Yes, it is a large portion of their earnings, but they also have other segments such as their fee income, which is a very large segment for them. So fee income has like credit card fees and the wealth management arm, which is the banks have realized that rates will definitely be trending downwards in the next few quarters, at least next year. So they are trying to push out their fee income, which is their wealth management side, and as well as their credit card spending. And you also asked in general, which will the DPS payout by the Singapore banks drop? No, I don't think it will, because firstly, the banks are very prudent when it comes to releasing their dividends and how much dividends they are paying out. So whenever all the banks have actually said so, is that when they sort of like release these dividends, they intend to keep it at that at least for the next, in the foreseeable future. So they don't intend to lower their dividends, but they might not be increasing it as much if their earnings is not as good. I think the last time the dividends dropped was during COVID, because that was exceptional because the earnings also dipped quite a bit. But which is also another reason why the banks are very hesitant on giving a guidance on how much they're going to increase their dividends. I think the only bank which has done so would be DBS, where they said during their investor day in May, and they mentioned that they will be increasing at 24 cents every year. But then again, they also pushed it up by almost like by half a year, and they rose their dividends by 6 cents a quarter earlier. Faster than what they said, right? So the other two banks have not said anything, although they were asked quite a few times. So I don't think the second question is a no lah. Which of the three banks will drop is DBS first. There's also one question on the rates. Yeah, you can go back to the previous slide. Oh yeah, okay. Someone asked about the comparisons. Okay, let me answer this question first about the rates. Hold on, sorry, let me find it. Yeah. US interest rates relatively high at 5.5% now, with a possibility of another rate hike of 0.25 in November. And the question is how come our Singapore interest rate is not really moving up? So if you look at this chart here, you can see that the light blue line, it indicates the Singapore interest rates, and the dark blue, of course, is the US rates. So yes, recently, yes, it will follow the US rates quite closely, and you can see from even all the way up to like 2010, it has followed closely. But recently, I think it might be due to some MES might be thinking that it will hurt us more than benefit us by increasing the rates too high. So they have maintained the rates, and they have increased it quite slowly over the last few months at least. Yes, I think there's one more question. Yeah, sorry. This one is regarding the banks comparison. We will put it up here for a while, just for the viewer for the person who asked, look at it again. Okay, I think that's all the questions I have. I'll hand it over to the rest of my colleagues. Thanks.
Right, I'll take the question for Far East Hospitality Trust. Would like to have your opinion on Far East Hospitality Trust as a hospitality rate play? As mainly SJ hotel and service residence play, it will not have any forex risk compared to other hospitality rates. Yeah, so for Far East, we don't cover the rate. But something about them is there's a recent divestment gain of Central Square was 18 million to cushion the impact from possible higher interest expense, and the target dividend yield this year is about 6%. And in first half 2-3, the total RevPAR grew 96.9% year-on-year to 133, with the good demand from corporate groups and also further recovery in leisure bookings. And also the service residents, RevPAR of service residents almost achieved the record high, was $224. And with the normalization of flight capacity and increasing Chinese tourists, and also like increasing numbers of visitors attracted by several events, such as Taylor Swift, Coldplay, and the one we just had F1, we believe the occupancy rate and RevPAR will continue to trending up. Yeah, and you are right. They are SJ hotel and service resident, and it's a pure Singapore play. From now, because like they are also like eyeing acquisition in Japan, but the acquisition won't be a very big asset. It should be about like 70 to 80 million SJD. Yeah, and then after that, the overseas asset will be less than 10 to 15%. Yeah, hope it answers your question. Thank you.
Yeah, thanks, Miao Miao. Yeah, so there's a question on the vertical bar chart earlier shows the current month and year-to-date performance of the different REIT subsectors. The hospitality subsector shows downward performance. Why is this so if RevPAR has been increasing consistently this year? Yeah, so basically the hospitality is down mainly because of CapitaLand Escort Trust in the third quarter performance. Yeah, so how that was calculated is based on market cap weighted. So CapitaLand Escort Trust accounts for about 50% or even more of the hospitality market cap subsectors in Singapore. So because of the recent rights issue and the private placement, the share price corrected quite a bit. So that is the reason why even though the RevPAR has been increasing, yeah, we saw that the hospitality subsector is down quite a bit, yeah, mainly because of the rights issue of CapitaLand Escort Trust. Yeah, so hope that answers the question there. Yeah, the next one is, hi, are you optimistic about Parkway Life REIT going forward? Given the recent weakness in its share price, do you think it's a good opportunity to acquire some shares? Yeah, so for Parkway Life REIT, for some reason, the market has been pricing in the fact that they're always trading at a price to book of 1.5 times, and right now their dividend yield is at about slightly over three times. Yeah, but for Parkway Life REIT, they are undergoing a project renaissance where they are doing some AEIs. It's quite a major AEI for Mount E Hospital. So for that, over the next few couple of years, they'll get a slight escalation of 3%. But once the AEI is complete, they'll have a huge chunk of rental, rental growth that year. About if I remember correctly, it's 20 over % of growth. So that will benefit them. But looking towards the nearer term, because Parkway Life REIT is trading at 1.5 times and their dividend yield is relatively low compared to the other listed REITs. In fact, the dividend yield is somewhere similar to around the 10-year government savings bond. If you ask me, rather if I remember correctly, so it's about 3.5 times. Yeah, so right now I think it's still better to invest in a kind of a risk-free asset rather than a risky asset if you're getting the same dividend yield. And because of the higher for longer stance, yeah, it's hard to see any sharp share price appreciation in the near term for REITs, but we're in it for the dividend play. Yeah, so that's my view on the Parkway Life REIT. Yeah, the next question is, if property stocks are drag and underperforming, how come our Singapore residential property prices didn't correct? Yeah, so actually, our Singapore residential property prices has, not say it didn't correct, it has declined significantly since the last year. Last year was growing at an average about 2.1% quarterly increase in the property residential price, but in second quarter it was down, and then last quarter it showed a 0.5% increase. So the price increase has really slowed because of a few factors: more supply incoming, as well as of course the ABSD, as we all know, that affects the foreign buyers. So as a result, we saw that the price was slow, and we think prices may flatten going forward. So yeah, that is why we have as well as the more supply coming this year. So the take-up rates are also not very high as compared to last year. So that is why we are neutral on the sector. Yeah, but the prices are starting to slow already. We've seen that in the previous few quarters. Darren, is CLI dividend yield? Yeah, so we forecasted a CLI dividend yield of slightly under 4%. We forecasted a 12 cents dividend for the year for CLI. So that's around slightly under 4% at current share price. Hi Darren, good to know Escort's forward DPU yield is around 5.7%. FY rights price should be 1.0251. Yeah, correct. Yeah, thanks for highlighting. I think I mentioned wrongly earlier that the rights price was at $1.25. It's actually at $1.025. Yeah, that's correct. I think sorry if it came out wrong earlier when I tried to say it. Yeah, it's $1.025. Thanks for highlighting that. Yep. Yeah, please show the percentage debt maturing in 2024 of total debt for the following REITs. Please enlighten if the debt has been refinanced. So the REITs, Maple Trees, Capital Lands, the Frasers, Keppel DCs. Do you have a table? Yeah, so actually I do have a table. Yeah, let me finalize it. So let me just read out some of the debt expiring in the next FY that I have. So basically, most of the Maple Trees and the Capital Lands, they are the percent of debt expiring is less than 20%, so it's around the teens to almost 20%. And then for the Frasers, the FCT and FLCT is about 22%. Yeah, so all this is as of the first half result. So a lot of it has not been refinanced or hedged yet, but there are definitely already started discussions to refinance, or and the hedging process as well. And Escort is 19%, and Keppel DC is low. Is next year only about 4%. Yeah, only about 4% of their loans expire. Parkway Life rate is also at about 20% that expires next year. Yep. Yeah, I think that's all for me. Let me hand over the rest of my time to the colleagues first.
Let me take over. Okay, I think there are some 5 questions for me. Read out the questions. Is there some risk in the energy sector, Keppel Corp, Sembcorp, as they need to transit to cleaner fuel, or for example, higher upcoming capex? Yes, as they invest in the new projects, the new type of power plant, there will be capex. But the Energy Market Authority is also aware of this, and they had came out to say that they are ready to be participating, or to even to be funding the construction of these plants. So the Keppel Corp and Sembcorp looking to maybe as a part shareholders, or to just to be an operator of these plants. So and Singapore also have this infrastructure fund by the government that could be spent in this area. So therefore, we think both Keppel Corp and Sembcorp has both said that they want to make their balance sheet light. So meaning that if they were to embark on these projects, they probably take a stake that is lower than 50%, so that it does not burden the balance sheet. So we think we're quite these companies are quite aware of their returns that they need to generate ROE to shareholders, and this is something that they will be very, very careful with investing. I hope I've answered the question. I think not sure whether I read the question. That's what the person asking is looking for. If it's not, please send a follow-up question and I'll deal with it again. Okay. The second question is impact of Middle East situation on oil price and how it affects RH Petrol. Saudi still go ahead to normalize relation with Israel. Not sure about the Saudi part. This war is really something really unnecessary. In my opinion, we really have pain with Russia and Korea, and the elections coming through in the US next year. We don't need another war actually. But definitely it will keep the oil price high, because the conflicts means that the products coming out from Middle East could face with supply chain constraints. For production companies, oil production companies like RH Petrogas, definitely a direct beneficiary of the higher oil price, because it reflects straight away into their revenue line, and also they will help to improve the value of assets, and it means the less need to write down the exploration assets. But they also over the weekend has also announced that for Irish Petrogas, that's one of the fuel is not producing, then they had to do some write off for one of the asset. For Rex, similarly will benefit on the top line, but Rex recently has some issues with the with their Oman plant, and they also pull out from Malaysia. So therefore, in the near term, you might also see some write downs for Rex in the balance sheet. So if you are bullish on oil price, it could probably be more advisable to buy an oil ETF instead. So the other sectors that might benefit are the coal miners, because the higher oil price means that there will be more consumption, more will be switching back to coal for production of power. So the oil miners and coal miners might also benefit from this higher oil price. Thank you. Given the next question, given the earnings visibility of ST Engineering, is there any chance that ST Engineering may increase its dividend payout in the coming quarters? Now they have committed to pay out a 16-cent dividend, which is 4 cents per quarter. We don't see that. We asked them whether they will raise it. They have not made any commitment for that. We think as they continue to digest the investment in TransCore, the dividend payout could be increased only maybe from 2024 onwards, when TransCore begins to contribute positively to earnings and cash flow. So there's a chance, but still they at the 16 cents dividend per share, they're still delivering a yield of above 4%. Okay, this question is on Sembcorp. Sembcorp share price has taken a beating recently. Why? Near or mid-term outlook? Yeah, I've been asked these questions by some EC investors as well. The thing we can think of is that the higher interest rates, which they if you recall, they sold their India power plants and they collected $2 billion. They didn't collect the $2 billion, but in exchange for that, they had a deferred payment notes from the buyer of these power plants. The deferred payment notes is on the floating rates are estimated about 9% interest rate. So with the higher interest rates environment, the market is concerned that whether the buyer of this the buyer of these power plants and therefore the issue of these notes will able to service their coupon on the notes, and Sembcorp generates about 160 million interest income from these notes. So the collectibility of the interest as well as the repayment of the notes become the risk is raised because of due to the higher interest rate. So I think that is a concern out there voiced by a few of the investors. Thank you. Hi Peggy, is there any improvement in Keppel Infrastructure Trust income structure? Why has the price dropped in the last 2 weeks? We met the management maybe 3 weeks ago. Yeah, I think the prime priority for them is to refinance the KMC debt, so that once it's refinanced, KMC as the distribution from KMC has been held back from this year onwards because the debt repayment timetable is kicking. So therefore, there's about 454 million of distributable income from KMC that has been is no longer coming through this year. So the management is very focused on refinancing the debt so that they can resume the repayment, the distributable income from KMC. So that is their priority currently. But again, with the another thing that KIT has said they need to do is to buy over the capital desalination plant in the near the sorry the what's that near the south of Singapore. They are supposed to buy over from the Keppel Corp, but because of the interest rate, high interest rate currently, they're still raising the funds to do that. So they are out there in the market looking for funds to raise via some bonds or debt structure, and therefore I think the share price has also reacted to that as the cost of funding has gone up, and so therefore affect their KIT's ability to raise funds for these acquisitions, which will then impact their ability to maintain their distributable income going forward. Yeah. Thank you.
Switch between various tasks. So that's when you need to have organize. You need to organize the workstation to facilitate the efficient task transition.
There's another question for me. Hi Peggy, what is your view on C3? Same thing. I haven't changed my view yet. Even though the oil price is high, will benefit will probably motivate the equipment owner to think about investing in new equipment. But the higher interest cost is will also make them be very cautious with their capital investment plans. C3 is still loss making this year, and then now that the oil price is another bull cycle, and they are in a loss situation, they probably miss this cycle completely. So it's quite sad. And for them, the focus is really on the renewable type of equipment. 40% of the order book is on the renewable side, but that's what they try to capture. But the core main part of the business now is still from the Petrobras for the FPSO, the fossil fuel kind of type of equipment that runs on the not so friendly fuel. So the high dependence on Petrobras is something that we are concerned, especially with the investigation on them is still ongoing, and we haven't seen any progress thus far. So therefore, I'm very I'm neutral. I'm not bullish on C3. I think I'll pass back to the rest while I try on the other question. Thank you.
Okay, thanks. Let me just try to address some Israel-related geopolitical tensions. What can we learn from the events of 73 and 2023? In your view, what are some safe potential haven counters? I'm not sure if equity would be a safe haven. I think if you have such a huge geopolitical event, the safety usually is in gold and of course treasuries. I guess it's just a reminder that maybe sometimes the portfolio you might need to have some, I guess, insurance in the portfolio. Of course, I don't think we should be buying it now because maybe you should buy insurance when the premium is low. So maybe now that the premium is high because everyone's so alerted by this event. I guess it's just to monitor if this is just a contained conflict in Israel. doesn't spread to Iran, then I think this thing can also blow over the next couple of days. I mean, that's my own view. Unless somehow Iran gets involved in this, then I think then all bets are off. But since Iran, because we were that's my own view. But if it's just contained, then like all things, because war. I mean, not good to say this, but I mean, this conflict has been around. I don't know, since the late 80s, Hamas and Israel. So it's not like something new that suddenly there's this conflict in Israel. But it's just the severities. But if it's contained, then I think it's fine. I think then this will just blow over and then things will normalize back. So my own view is not to overreact to it and start climbing into buying into gold and so forth. Yeah. Although gold didn't really react that much. Looking at the GLD recently. Singpost, what are some options that can drive a return to profitability? How can the company reinvent itself? I think the first phase of the turnaround for them is to resolve the whole restructuring of the Singapore postal system. So I think the government has come up many times. I think that they are willing to support. You already seen this by the authorities raising the postal rate. So my own view is that the downside is also it can only get better for Singpost from these levels, because they've explicitly mentioned that they need to change the whole business model. I mean, the authorities. So we're not sure what is the model. The model could be like a net fixed model. I give you a fixed price. You tell me what's the return. Then every 5 years I change it. It could be the comfort SBS transit model where I'll just pay you a fee and then you run it. But if they do that model, they still have to compensate Singpost for all the infrastructure, all the capex that they spend. So regardless what happens, I think it will be a win. Not say windfall, but it will definitely be a benefit, because whatever model that happens, they either get better returns, the government subsidize, or the government take back the assets and then they will have to pay Singpost something. Regardless which permutation you take, I think Singpost will definitely be a big winner, because they need to return it to profit. That's my own view, because not that I've seen any documents, but based on the way private assets are, the infrastructure where you have a monopoly, like Netlink is a monopoly. Likewise for the rail, I mean the train is virtually a monopoly. This is how the government tends to treat it. The longer term, then that's the one part of it. So that could actually help push the share price up. Now that the postal business can have a reasonable returns, which is what the government is already hinting that they should have some reasonable returns. Especially in this rising interest rate environment, it should benefit them even more, because they should have a return that should exceed the WACC, however you want to compute it. The second thing is more on the Australia business. They do have quite an interesting asset there, because it's a very platform business. But just in the near term, I think they'll be cyclically down. The international business is a bit touch and go. International parcels business, because I'm not really sure where's the competitive edge, apart from Singapore, because Singapore has so much connectivity. So that could be their edge. So these are the things, the paths to it. But my own view is that they should get a lot up. There should be quite a lot of upside for this stock, because you already have the authorities underwrite any more losses that you have in the postal business. Which the authorities underwrite you and anything. I mean, I thought that would be a good situation for them. Okay, that's it for me for my Singpost view. For what it's worth. For JP, okay, this is JP Morgan said that central bank could hike rates by another 1.5. I'm not sure what's his rationale. I think what he meant could be more the government deficit rising. Of course, Jimmy Diamond forecast is like 100 times better than mine, but he obviously has made mistakes too. I mean, he thought there'll be a collapse in the economy early this year. He also thought the interest rate would be 5% in 2018. But I think to get that scenario, it's not. If the deficit really skyrockets and then everyone starts to run away from the US Treasury. But the offset for that is that with all this, with a slower economy and the Fed cutting rates, I'm not sure how fast you can hit the 7%. The only way you can hit 7% is that you cannot control interest rates. I mean, your oil price hit maybe $150, then maybe the time all bets are off. At that time 7%, So if all hit $150, then the Fed don't raise rates, right? Because inflation is going to run out of hand. But if just the deficit, then no, the Fed can actually monetize it. I mean, they can actually buy back the bonds. So for me, the only one scenario to hit 7% is if all price hit $150 or $200, then
Yeah, so this
there's
is
no
a
choice. Then
campaign
inflation is high, then the Fed has to raise rates. Otherwise, you can monetize the deficits, right? I mean, Japan is also, the debt is 200% to GDP, but the interest rate is hardly anything. So the central banks can control the interest rates, I would say. Okay. Hi, there's a correlation between oil price and palm oil price, as oil price has moved up, but palm oil price sector, example, Wilmar Shep, has not moved in tandem. Is the El Nino thesis benefiting all sector intact? Yeah. Okay. I apologize. I didn't really do a correlation between oil and palm oil price. But anyway, when oil price rise up, it will hit palm oil sector in a few ways. Number one will be the fertilizer. So fertilizer is 30% of their cost in general. I mean, it can vary day to day. So the increase in cost should actually push up the price. Number two is of course biodiesel. Then it becomes more attractive to use biodiesel compared to diesel. That should be the second reason. But the reason why we hesitate is that palm oil price also dependent on a lot of factors. It depends on soil price. Like recently, palm oil price collapsed because rapeseed oil price collapsed. So I mean, even though oil price is up, so there's a few variables, but it will support. There is a supporting thing that if oil price rally, then palm should improve. On the El Nino, there's a higher and higher probability. Of course, I don't think you want to hear my weather forecast. It's probably all wrong, but there's a good chance. I think the latest forecast, the probability is high. But the one issue is also if there's El Nino in South America, then it also means soybeans production will also increase. So it could also put pressure on soybean price. But in general, I think I do agree with the attendee. I mean, there is upside, but I'm not sure. I'm not sure if Wilmar is the proxy to buy, because Wilmar has also edible oil business, soybean crushing, which is affected by Chinese consumer demand. So if you want to play this, you might play the purer way, which is like First Resources or even Golden Agri, rather than play through Wilmar, because Wilmar, the other engines for them is soybean crushing, which is the feed mill to feed the hogs. And also their edible oil, because they sell cooking oil in China. So if China demand is weak, then it might also affect them. So the more direct exposure, if you're playing at El Nino, high oil price would be the First Resources and Golden Agri. I mean, that's my own view. Okay. Why not StarHub instead of Singtel? So I thought Singtel has a few more drivers for them. For StarHub, just that I'm still worried. Of course, I've been worried for the last few quarters that although we have accumulate, just that we are worried that the third quarter might still be sluggish because they still have to spend on their the transformation. But I thought Singtel had a few more drivers because there's mobile repricing. The only thing that's weak for Singtel is Australia. That's the only weak part. But the other, I don't know, 9, 10 engines are doing well. So I thought it's a better way to play it. Yeah. StarHub driver would be if there's consolidation in Singapore, they will consolidate, and Singtel is also going to benefit, although it will be smaller because Singapore is probably like only 10-15% of their valuations in Singapore operations. So that's the reason why I like Singtel more than StarHub currently. Tiong Moon, I think I leave it to Peggy. Is there a recorded version of Assets Singapore Outlook? Isn't it the same as morning's yeah. So we normally put it in our Philip YouTube webinar, the Philip Singapore. So that is a bit longer. That's almost that's the full deck of the presentation. This one is just a shortened version. So that's what we normally do. I'm really sorry if you listen to if you are listening again, but that's what we normally do. After Saturday, we normally follow by a Monday, a shortened version of our Singapore Outlook presentation. There's a Suntec question. I'm not sure. Hi Paul, I'll answer this last before answer two more, then I'll just leave it to the rest. Harper, what's your views on the impact on Israel war on the US and Singapore stock market? I think it's something to, it's obviously going to be a negative. We just saw the US. So the two biggest impact for us will be, of course, oil price. But again, sorry to keep repeating this. If it doesn't spread to Iran, then I'm not sure how much oil Israel consumes. And this is not like a new war that suddenly appeared. It's not like a 9/11 suddenly. There's a totally new new risk that's emerged. I mean, Israel. I mean, sad to say again, this is a war that's been around for many years, sadly. What's your view on Katrina? So Katrina is a F&B operator, and they also own some rental homes, a bit of a co-living there too, and service apartments. So they did a interesting corporate exercise, which is a rights issue of warrants only. The market cap of this company is 5 million. They're raising 200,000. But the book value is negative 6 million. I was looking through the data. So I mean, when you're doing a rights issue just on warrants, then I guess it's just I don't know, at 2 cents is at 0.001 and it's renounceable. I guess if it's just a more of a pun rather than anything else, because their F&B business was surprisingly weak, even though most F&B companies reported record earnings, at least just when the pandemic came out. But I think for them, it was still weak for them. If I'm not mistaken, they made only like 300,000, if I'm not mistaken. So I really got no strong views. Just that when you have a rights issue on warrants, of course, it's a fun way to trade the stock, but obviously there's not much volume. Yeah, I'll hand it over to the rest. Sorry, I missed the Stats Singapore outlook. Is that recorded? Yeah, our recorded version is actually on the Philip Capital YouTube channel. It's not uploaded yet, yeah, but it will be uploaded soon. I'll leave it to the rest. Yeah.
Handle surface or handle material. And when we look at tools and equipment,
Maybe I take the question on Tiong.
technology, there'll be more power tools that are available.
Can you read out the question?
Causing us not to use so much
After
manual
reviewing
labor,
Dongwon's
there'll be pros
latest
and
annual
cons
report,
on
it's
manual
evident that the
versus
company
power
maintains
tool.
positive
For
outlook
manual,
despite
it
facing
can
various
make you
risks
more
and
efficient because
macroeconomic
you
challenges.
can work it
Is
a
it
bit
worth looking at
slower,
this company? Are there insights
and
to
you can
share
also
on
bring
this
it
company?
along. It's easier to store in a small and tight space.
Also,
And you can
there are
easily use it
similar
when
questions
there's a
on
space that has
Tiong.
no power
So,
source. It is also
okay,
cheaper,
I
unfortunately.
met the
It is
company,
slower, which require more effort when you're
not
using it.
but not enough.
While power tool
Haven't
can
done enough
be
work to
fast
give a
and
very
consistent,
good
also allow high
review
frequency
and good
also force and
comments
motion
on
the
them,
hand.
because
It can
I've
be also
yet to check
easier
out their
and
competitors.
bulky,
The
also more
competitors are the
expensive.
big
If
European
you use a power tool,
crane
you may need to
owners.
train the employees, and that
I
includes
also
extra training
trying to
time. So that
ask them
some of
questions
the
on why
pros and
they
cons for both manual and power
how they
tool.
see
There's
this
no
sector and why
right
are
or
they
wrong
not
for using
competing
which
as
one, but it's
aggressive
just which one
as
fits the
aggressively as before.
workspace, fits the user,
So I'm not
task and the
have
function
enough
better.
data points to come up with an answer. Okay,
Consideration on
the
handle design.
basically
You can see how the
Dongwon
handle design can affect
will
the hand
benefit from
surface
the
posture,
increased
like you see
demand
on the
for
picture on the right side.
prefab
Yeah.
fabrication work for prefabrication work for Singapore building construction activities here in Singapore. That's also underpinned by the HDB requirements to have 50% of the PVC 100% of their buildings to be constructed using the DFMA method, of which PVC is one of them. Okay, so when you have prefab construction, you need the cranes to lift the parts, the components to a very high level. So those crane operators who have higher tonnage cranes will be able to bid for these jobs. On the other hand, also the European players have been very big in this space as well, and we're also concerned that there's not much barriers to entry here. If the consolation is that there are not many deep pockets construction companies out there right now, so there is construction companies are are very nimble. They are very agile when it comes to going upstream or downstream diversification. So they if they see demand for that service, they can always add themselves. They can always put in that service themselves, because they are the one who will command the work anyway, right? So we see very the barriers to entry is low, except for maybe the need for track record. So it's still in the whole entire construction ecosystem. We still think the guys who supply the materials will benefit. We look at the ROE for PenU, ROE for BRC, or PenU is at least 16%, so way above Kyungwon's 5% ROE, and there's also less need to finance the equipment to have a big balance sheet to support the fixed assets. Yeah. So sorry, I couldn't. The short answer is I don't have a firm view on Dongwon. Let me do more work. I'll come back maybe the next time.
If you look at the taxi driver on the right side, perhaps he will be in a sitting position for long.
That's a question. Okay, oil price up, benefiting Yang Zhejiang or not? Okay, the Yang Zhejiang's order books are mainly container ship, some bulk carriers. They have stopped taking LNG carriers because the LNG carriers sit in the yard for a long time and occupy the space for too long, so that's not efficient. So they move on to doing the methanol, the dual fuel vessels. So it will, the higher oil price will probably benefit those who do oil tankers or oil product carriers. But indirectly, those yards who are specialized in these vessels will be kept so busy, so they will not have either time to think about coming into the space that they are to produce other to construct or to repair other types of vessels. So indirectly it will benefit Yang Zhejiang, but not Yang Zhejiang not exactly a direct beneficiary of a higher oil price. The thing to think about higher price is that it will move up it will raise the cost of production for many companies. So therefore as a the margin impact, there could be some impact on the margin as the cost of production is increased. Okay, that's all I have for this question. Thank you. Can you flash the first 2 to 3 slides of the webinar again? Thanks. Maybe Ambrish, can you help us with that?
Yeah, Darren can take the rest.
Yes, thank you. Very good. So thanks everyone for answering my questions. I think we have covered most.
Yeah, sure. Yeah, I'll leave the Suntec and Lendlease question to Miao Miao. Any opinion on FLCT? What's our current P and gearing ratio? Yeah, FLCT's gearing is very low. It's under 30%. It's at 28%. But usually for REITs, we do not value by PE. Is because of their stream of dividends and such. We usually either use DDM, discounted dividend model, or DCF. Yeah, but FLCT I'm not too familiar, so yeah, I can't comment on that.
Especially during peak period and bad weather, and whether the mental load that's required when you need to be
taking an average of 20% of total debt expiring next year that needs to be refinanced at current high rates. Is it significantly negative for those REITs mentioned? I would just say it is significantly negative, but it definitely is a negative. And 20%, if you take on average, like let's say you take a rolling 5-year loans, so logically on a rolling basis, about 20% will expire every year. So I guess that 20% is quite a a normal thing, or rather is all okay. Yeah, but yeah, definitely when they refinance, they will have to pay higher rates from the base rates, and in this current market as well, likely they will have to pay a higher bank margin as well. Yeah, so that will result in their interest rates rising quite a bit. But at least the silver lining is that we know that rates have already risen so much. So the REITs, although they may say that they take a stance that they do not hedge for speculative purposes, so but we think a lot of the REITs, they are likely not, they will not want to hedge so high, or rather like 80-90% of the debt going forward, as we all know that the rates are unlikely to increase a lot further. Yeah, so it is definitely negative, but I wouldn't say it's like significantly negative and very detrimental to the REITs. Okay, that's one. If recession bites come 2024 in affecting valuation of properties under REITs, which may affect their respective gearing ratio, under such scenario, will REITs, in your opinion, will its gearing ratio affected adversely in the next funding exercise? Yeah, so definitely if especially for the US office, like in their next valuation, we expect that the valuation of the office space, because of higher vacancies as well as higher interest rates, is likely that the REITs, the year-end valuations will decline. But a lot of the REITs, they still have a slight buffer. Like for example, the one that all eyes are on is Prime US. So just an example for Prime US, they have about a 5% asset devaluation buffer before it reaches before gearing reaches 45%, and about a 15% asset devaluation buffer before it reaches 50%, which is the MAS threshold if you have 2.5 times gearing. Yeah, so it's likely that their gearing might be affected slightly when year-end valuations come in, but for the Singapore assets, the valuations in Singapore are still remaining very solid, and a lot of the time we also see a lot of the divestments at premium to valuations, which means that the demand is still there and asset prices are holding up in Singapore. So for REITs with majority Singapore assets, we do not see much valuation decline that will affect their gearing ratio significantly. Yeah, so that's what I have to say for that. Yeah, I think I'll hand over to Miao to first answer the Suntec and Lendlease question. Thanks.
Thank you, Darren. I'll take the Suntec one. Do you think Suntec or Lendlease rate will benefit more from interest rate environment with excess cash, or would you invest in CICT instead? Also, they definitely will not be benefit from the current interest rate environment, but we also expect the first rate cut is likely to be the second half of FY24. And Suntec with lower fixed portion of the debt will be benefit the most. And our valuation breakdown by geographies, Singapore accounts for 76% for Suntec, and the cap rate remains stable around 3.4% to 5.7%. So we don't see there will be any significant decrease in valuation that will further increase the gearing. Yeah, for Lendlease, with the new rate taking effect, the interest rate for FY24 is expected to be around 3.5%, and the current gearing is 40.6%. And we think that they won't be having any divestment or acquisition in the near term. So they are currently trading at a dividend yield of 6.53%. And for CICT, we don't cover the rate, but it's definitely more diversified and has less overseas exposure, and thus it doesn't expose much to the FX risk. But somehow it's like similar to Lendlease and Suntec. The leverage, the gearing ratio is 40.4%, with average cost of debt of 3.5%, as guided by the management. and dividend yield is 5.3%. So we expect higher revenue and NTI, but the DPU will more or less be flattish because eroded by higher interest cost. Yeah, hope it answers your question. Thank you. I'll hand over back to Paul.
Yeah, thanks. We'll take on this last question, but do note that the next few days, later at 1 p.m., we have our Malaysia market strategist talking. Tomorrow we have Oceanus. Wednesday we have Thailand, our Thailand strategist. Thursday we have our US Jonathan, our analyst, and then Friday we have Indonesia. So the next 5 days, we do have the continuation of our strategy talk by all the various regional countries, including Hong Kong, which I'm not particularly sure which day, but yeah. Oh, okay, let me just address this last one. Hi, Paul, what can you read and deduce from the just announced non-farm payroll data? Do you think the next coming one will be even stronger? Oh, okay, so the recent payroll numbers or jobs numbers in the US was that took the market up was about 300,000. 300 plus thousand, higher than the market thought expectation about 170,000. But for us, when we analyzed the data, we wanted to see if this is really a reflection of a strong economy. Sadly, it's not. The reason why we said that is because I think almost half of the additions, about 100 plus thousand of it, came from government. So government was a big addition. Then came healthcare and social services. So most of these are not economic sensitive, and the only private sector that enjoyed a lot of growth was the leisure sector. So that's why we are a bit skeptical that this is showing the strength of the US economy, because as you all know, we think there's a slowdown, so we were looking at the numbers quite sharply. Do you think it will be even stronger? We think it was. I don't think it will be 300,000, but it will still be above 100,000. The reason why we say that is that if you look at the leisure and government, they are still below pre-pandemic. So after the pandemic of, let's say, March, so even after 3.5 years, 21, 22, after 3.5 years, they still haven't caught up to pre-pandemic. So that's why you see this big replenishment in the headcount. So leisure is still almost 200,000 below pre-pandemic. And that's the problem we're going to have, because if the Fed looks at this label and sees this as a strong economy, but most of these are not these are government, it's not reflection of the economy or interest rate sensitive. Then if they want to push up rates, then it's going to be dangerous for the economy, for the US, because it's not really showing a strong economy, it's just showing a replenishment of the jobs lost during the pandemic. So that's why we still have the view that the economy is slowing, and any rate hike is just going to worsen the situation. And as you know, jobs is a very lagging data point to use. By the time as we speak, jobs are high, but actually, if you ask any headhunting companies right now, they tell you that the jobs data and the hiring situation in Singapore especially is also quite slowing down quite sharply, even though the headline numbers are up. Okay, I think with that, I'd like to thank everyone for your time, especially for our questions. And as usual, we actually will repeat what we did on Saturday. So that's where we did. And thanks for your questions, and thanks again. I apologize if you've seen this again before, and hope to see you next week. And do look out for the next few days of seminars coming up. Later 1 p.m. there's Malaysia, and then there's Oceanus and so forth. And thanks everyone for your time, and have a good day ahead, and a good week ahead. Thank you, everyone.
Physical activities guidelines for adults from 18 to 64 years old. The first, why do I share this? It's because staying active is important. Staying active is to keep your body stronger, so that will allow you to take more load and strain on the body so that you can cope better when you have to work, especially a physically demanding workload. Yeah. You want to aim, according to the guideline, you want to aim for 150 to 300 moderate intensity aerobic exercise per week. Yeah. So moderate intensity aerobic exercise means that you should be still talking comfortably but not able to sing. Yeah, when you're doing the exercise. So second points here is to get moving and mix it up. Yeah. So you want to limit the amount of time spent being sedentary by engaging short activities of any intensity. It can be a short walk, stairs that you can do from point A to point B. Yeah. And the last point is about getting stronger. This refers to some exercises that help to strengthen your muscles, loads, bones, joints through moderate to vigorous intensity exercises for at least 2 times a week. Yeah. So if you type like HPV physical activity guideline, you should be able to see this poster easily. So I'm going to share some of the exercises that you can consider. So perhaps when you're doing them, do stop if you experience any pain and discomfort. You want to just do them as much as you can tolerate. They'll be done. I'll be sharing 1, 2, 3, 4 exercises that can be done in standing. So if you want to stand up now and just position yourself at a safe, comfortable area, make sure if you need some hand support or near to the wall or the chair, you can do that. I just look at the chat. I think someone asked for the link for the tick break video. Yeah, I can share that. So let's look at the first exercise now. So this will be this is a hip opening exercise. It will be a good movement to warm up the hip, warm up the legs so that you can move better and stretch your leg better. You just have to lift the leg to 90 degrees and then swing it to the side while keeping the pelvis and the back in a straight position. And come back to the center, lift the leg up. So you can do that with hands supported near to the wall as well, or even the chair. Just make sure that you can stand on one leg comfortably before you are doing that this hip opening movement. So each side you can do about same thing 3 to 5 times or even more. As a warm up, you should be able to move it quite comfortably for a few times. Yeah. So trunk rotation. This is to stretch you can feel the mid back, the lower back, and a little bit of the hip movement, but mainly at the lower back. So just put your hands kind of straight and twist the body to the right, come back, and then twist to another side. If you want, you can also hold in that twisting position for a few seconds, and then come back to the center, and then change to another side. So 3 to 5 times, or even 5 to 10 times for each movement is good. So this will alleviate some of the back stress or even the mid back stress that you are having if you are working for prolonged period of time. The next 2 exercises will be strengthening exercise. The first one is squats. For squats, it means to improve or strengthen. You will strengthen a few muscles here, the hips, which are the buttock muscles, the quads, which are your thigh muscles. At the same time, you are also engaging the core, and because you are keeping the trunk in a fairly neutral area, you're not just relaxing it. So at the same time, your core is activated. Yeah. So as a safe, if you haven't done it before, you can grab a chair and then try to imagine you're sitting down on the chair, and then you can just come up. If you have done it before, you can aim to go a little bit lower, or even holding onto a weight to increase the difficulty of this exercise. So you can start with as light as 3 kg and then squat down and come up. So for strengthening exercises, I usually would advise at least about 10 to 12 times. You may want to do that for 2 to 3 sets, 2 times or 3 times a week to have that effect of strengthening. Yeah. So that's squats. And the last exercise that I want to show is lunges. So this is a more difficult exercise where it involves coordination, balance, as well as more leg strength, and it's more targeted to the front leg. So you're gonna step in this position, and then you should control the lunging movement with the front leg rather than the back leg. So the back leg is just there to support. Yeah, back leg where the toes is on the floor is just there to support the weight. Yeah. So this is a static lunge. And then what you're seeing now is what we call a backwards lunge. So you can alternate doing the right, left when you're doing a backwards lunge. So it requires more power, more balance, more strength when you're doing that. So as a progression. And of course, some might ask, can I also carry a weight and do that? Yeah, you can. So if you feel that this is too easy and you don't really feel that it's challenging the legs, you can always carry your weights and increase the difficulty of this exercise. Just make sure you do them according to what you can tolerate. Yeah, you should feel some muscle ache, but shouldn't have any joint pain. If you do, you should seek some help or ask your healthcare professionals for that. Okay, so that's essentially the main sharing. So I think for key messages, I'd like to again highlight the importance of ergonomic friendly workspace and promote employees' comfort and health. It improves the productivity and reduce the workplace injuries. And the second most important thing is when we look at workstation design, workspace design, and tool selection, there are four main principles or key points that we want to consider. The first one will be the functionality, whether does the design fits the function and the tasks that needed. Second will be the layout, whether the design fits the layout space that you have, that will encourage communication and workflow. And users, where does the design fit the user, fit the employee. And lastly, does the design impact the safety, productivity, as well as quality in a good way. And with that, we also need to have good ergonomic practice, frequent breaks, looking at work schedule, work pace, as well as staying active to make yourself stronger so that you can cope with your workload and reduce the risk of injuries. And here is my reference. And I am open with any Q&A. I saw a question, this exercise suitable for pregnant lady? I think for pregnant lady, there will be different trimester that you are allowed to exercise. Some would, depending on how's the pregnancy, I think the best is always ask your gynae doctor and see whether you are allowed to do exercises and when are you allowed to do them. Yeah. So a bit hard for me to answer because it very much depends on how's your pregnancy like. Yeah. But generally, we do have some pregnant lady that will be doing some form of exercises. I guess the stretches is definitely okay. I'm just a bit more concerned of the strengthening, whether are you allowed to do them, yeah, during the different stage of the pregnancy. Rosalind, I can share the video. Actually, the video link. I'm still open to any questions, but at the same time, I'm just gonna quickly search for the video. Any other questions there? No? Okay, then I'm gonna end my slides. I'm gonna stop sharing. Nisha. Okay, I just put the link into the chat. Yeah. Yeah.
Thank you, Chacha, for sharing with us on how we can enhance workplace ergonomics for the non-office employees. I hope everyone has found this session to be informative and useful. So, if there are no further questions from the audience, please scan the QR code for attendance and feedback if you have not done so. And do note that in order to qualify for the quiz entry, which I will show it to you later, you will need to complete your attendance for this workshop by scanning this QR code. Okay, so you can also find the link in the chat. I will just leave it here for a few minutes for everyone to scan. QR code for the quiz as mentioned. The first 5 people to answer correctly will stand a chance to win a $10 NTUC voucher from us. The link will also be found in the chat, and I would like to reiterate that participants are required to register their attendance before taking part in this quiz. Yeah, so I'll just leave it here for 2 minutes for everyone to scan. Yeah, I think if there are no further questions, I think Chacha wants to leave. I think
Okay.
alright, thank you very much, and
Thank you. Thanks.
Recording in progress.